I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of our Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets while also drowning out the agenda of the news media in America. So we like to go through the 4 things that we learned in the markets this week. First off, for the week, the S&P 500 edged 1.21% lower. The Dow Jones Industrial fell about 0.16%, and the NASDAQ, which of course includes most technology stocks, fell about 2.62%. Now, some are suggesting that this week's stock market drop we've seen, which concluded a few weeks of positive returns, is because St. Louis Federal Reserve President James Bullard indicated what many of us already knew, that they're going to have to continue pushing interest rates higher to continue fighting inflation. The markets were perhaps trading in the possibility of a slowdown in rate hikes, but it doesn't seem that that's going to happen. Additionally, just today on Friday, we saw 1 to 2% moves to the downside, which partly could be explained by almost $2 trillion in option contracts that are coming due, which adds volatility to the markets because those investors are forced to close out their positions with either a buy or a sell. Point number 2, Wednesday's U.S. retail sales report was broadly better than expected. It showed us that since consumers recently have caught some breaks at the gasoline pump, they've started to spend above the inflation rate, which is the highest levels in nearly half a year. This gives our investment committee team at Whitaker-Myers 2 quick thoughts. 1, if consumers are now spending above inflation, which they haven't done in the last 6 months, this provides a positive backdrop for Q3 corporate earnings. Secondly, on a more negative note, it tells us that the Federal Reserve's interest rate increases, which are designed to curb spending and slow down inflation, are not quite having their desired effect. Thus, more interest rate moves, and let's go back to point number 1 we just talked about, are going to be needed, partly why we've seen the market take a breather this week. Point number 3, in regards to real estate investing, U.S. office occupancy remains very weak, which can be common during the summer months. Now, we use Castle Systems data to track this, and that it tracks U.S. office vacancy rates, and we showed that New York, Chicago, and LA showed declines the last week. New York is at a 38.3 occupancy, Chicago's at 40.1 occupancy, and LA's at 43% occupancy. Compare that to some of our favorite markets where we serve our Dave Ramsey fans, listeners and followers. Austin, Texas is sitting at 58.2 occupancy, much better. Houston, 54.7 occupancy, and Dallas at 50.4. These 3 Texas markets are the only major metros to have less than a 50% vacancy. And keep in mind, the numbers that I talked about above were occupancy. This begs the question, what is Texas doing that has every other major metro that's doing better than 10% from an occupancy standpoint with their commercial real estate? This is one reason why we have steered our real estate investment purchases away from New York, Chicago, and LA. Point number 4. Here's some interesting inflation data we learned this week from our friends at Axios Markets. Remember when lumber was the first thing to kick off this entire inflation game? Well, they're down about 60% since March, lumber is. How about used cars making quite the noise when for the first time ever, my friend Dave Ramsey was wrong? He said things with a motor go down in value. Well, that's not the case in 2021, but they're flat this year in 2022, and leading indicators are showing that there may be a very sharp downturn in used car prices. So please hold off on buying any used cars right now. And by the way, of course, we know that Dave is right. Don't borrow on anything with a motor. It generally does go down in value. Since oil prices have topped, they're now down more than 25%. We could go on with eggs, steel, grains. However, here is the key for CPI, which of course is inflation: housing. Housing accounts for such a large share of the inflation rate, and we may be just starting to see the downtrend in housing prices, with July posting a 5.9 decrease in sales. So that's one of the key drivers to watch with inflation is what does housing do? U.S. residential housing. It's one of the reasons why we're a little pessimistic on U.S. residential housing right now from a real estate perspective, and a little more optimistic on commercial real estate in the right places. So if you have any questions about this week's What We Learned in the Markets, please contact your advisor. You can click the link in the notes to schedule a meeting with your advisor. You can also click the link that will take you right to our blog, which has all the articles we've written for this week. We appreciate your continued trust in our firm, and we look forward to talking to you next week.